Hello everyone, welcome back to my YouTube channel. So many of you are asking me continuously that Rajat, can you help us with some amazing interview questions which are most repetitive in terms of nature. So today I am going to crack that aspect for your next credit risk interview. I am going to share this handbook which I have been using, and I have prepared this particularly after analyzing so many of interviews which I have given or which I have taken. Okay, so I hope this session will be actually meaningful for you. And just before we go forward, okay, the approach is that let's keep the words minimum. The reason is because if I give so much of language, that is going to be too much theoretical. I don't want to make it too much grammar or English oriented, right? That we are understanding grammar, punctuation, all that. Just focus on the concepts. That's why you will see the answers are 2 words, 3 words also, so that it's easy to remember. Okay, that's how I usually follow the approach. So let's move on to this. So first of all, generally, what is credit risk? See, this is for a person who's like totally new also. So this session is for everybody. Don't think that why are you covering such basic things, because there are so many new subscribers who come and they see. Okay. So what is credit risk? So credit risk is consisting 2 words. Credit risk basically combined credit and risk. So whatever credit you are giving, which is at risk, that is something we will now simplify. Okay. So credit risk is the possibility that a borrower, who is a borrower? We are the borrower. So let's say bank give us the money, so we are the borrower. So we will fail to meet their debt obligations, resulting in a financial loss to the lender. Who is lender? Lender is the bank, okay? And borrower is Rajat. So if I am failing to give the money back, that is known as the credit risk, okay? Now, what are the type of credit risk if you see? So there are 3 major type of credit risk. Number 1 is default risk, that I will default as a customer, okay? Then second is concentration risk. Then third is counterparty risk. So what is default? Let's say borrower fails to pay, that is default risk. Then what is concentration risk? Like too much exposure to one sector. So one bank has given all the loan only to the infrastructure, or let's say home lendings or home loans. That is like concentrated risk, okay? So that bank need to manage. And then counterparty, you have like opposite party defaults, okay? So you will understand this in much more detail. So when there are 2 parties involved, right? So counterparty involves the wholesale aspect also, okay? Wholesale is not just between 2 people, it's about business also. When there are loans given to big businesses or small, medium enterprise or small companies like a showroom owner and all that, okay? That is also coming under credit risk. Now, let's talk about the next thing, that is credit risk life cycle. So first of all, the application comes to us as a bank. Then you have the underwriting. What is underwriting? That we are checking the application. Then there will be a disbursement of loan. That loan is given to the customer. Then the bank will monitor the loan, the performance of the customer, that whether we are paying EMI on time or not, etc. Then if there is nothing, there is kind of a risk, there is nothing which we are paying. So that means now we are kind of a default customer, right? So bank will start the collection process, and then recovery agent come to your home, they will take your car, okay? And if this collection and recovery fails, bank need to write off the loan also. You might have understood it, that writing off means that now bank will show that as a loss in their balance sheet. That's what it means, okay? Let's move forward. Like what is PD, LGD, EAD? Because these are the most common and most number of models which are getting developed across all the portfolios. So PD stands for probability of default, LGD stands for loss given default, EAD stands for exposure at default. Like probability of default talks about what are the percentages that a person will default after taking the loan. LGD means what is the total loss bank will have if the person default. Exposure at default means at a particular point of time, what is the exposure bank have when the customer will default. For example, simply when I took the loan of 100 rupees, so today the exposure is 100 rupees plus the interest. After 1 month, maybe I paid 10 rupees. Now 90 rupees plus interest is EAD. That's how it's continuously decreasing. Now using these 3 aspects, why we calculate these 3 aspects? That question will come, right? So we calculate these 3 aspects because we want to calculate the expected loss, expected credit loss given by any particular loan disbursement or any product, okay? Now what is credit scoring? This can be asked to you. What is credit scoring? So it's a statistical model, okay? It can be like any linear regression, logistic regression, anything, okay, that predict the default risk, often used logistic regression. Logistic regression is most common here. Now, if you see what is default risk, default risk means a customer took the loan, he is not paying EMI for 3 continuous months. So now after 90 days, we will call this customer as 90 plus DPD. DPD stands for day past due. So after 90 plus DPD, the customer is converted into default risk. This is pretty much useful. Then in logistic regression, just remember one thing, You should remember what is logistic regression. Just remember sigmoid function is the core aspect of this. Let's move forward with the further question. What is secure versus unsecured loans? You can see that. Okay. So secure loans always have a collateral. So let's say when the bank is giving loan for your house. Now, if you're not paying the loan, bank will take away your house. Bank is the primary owner. When you sign all those documents, you always read that bank will be the primary owner of your property until or unless you finish the whole loan. Okay. Then what is unsecured loan? Unsecured loan are very much repayable behavior, or it's moreover dependent on the behavior of the customer. What is unsecured lending? For example, your credit card. So against your credit card, you are not putting any security. You're taking a lifetime credit card, lifetime free credit card, all that, right? So if I'm getting 1 lakh limit credit card, then am I giving them 1 lakh as a security? No. I just spend, I just pay. Simple. Then what is credit underwriting? So basically evaluation. When you are doing the evaluation of borrower risk, as per his application, that is known as the underwriting process. So evaluating borrower risk to decide loan approval terms. Okay, that's known as underwriting, but it's not much useful for you as a model developer, model validator. Okay, credit rating versus credit score. Again, this is very much confusing. Credit rating is for the companies. Let's say Infosys, TCS, all of them have a credit rating given by the credit rating agencies. For example, you have Equifax, you have Paynets, all of that. Okay, those are the agencies, they give the rating to the companies. Then scoring is for individual. Like for you and me, we have like CIBIL score in India. So that is credit scoring versus credit ratings. Then what is the risk grades? So there are so many internal category of the risk grade depending on the credit worthiness. Credit worthiness means what? Like what is the total credit we can give this particular customer? That will be depending on so many factors, like how much salary you have, how long you have been working in the sector. So all those shows your dependency, your stability. According to that, bank decide this. Okay. So now let's move on to the next one. A bit analytical thought process. Just think from that angle, like how PD is calculated using a logistic regression or a survival model on historical default data. Just remember this, how PD is calculated using the logistic regression in real world. I'm telling you, in industry, 90% of the model who are calculating PD are logistic regression model. Just remember this. Now, how is LGD estimated? LGD ka ek formula is there. It's there. Like you can see LGD equal to, simply remember, 1 minus recovery amount, the amount which has been on the recovered side, and then exposure or default. It will give you LGD, very easy. All these PD, LGD, EAD are co-associated with each other. Okay. Then handling missing value. So we use imputation. It's the most common one. Okay. So imputation, you should focus. Just don't use this Windsorization method. It's very much confusing. Then what is CSI and PSI? PSI stands for Population Stability Index. CSI stands for Characteristic Stability Index. Both measures the data drift. Now, in the model validation field, it is used. Basically, PSI shows that what is the shift in the population. Like there are, in last quarter, there were 100 default. So this quarter, there are 120 default. Why? Then CSI talks about individual column. Like for example, in salary, there is so much shift. In the geopolitical region, anything, any single column which is getting shift because of the any factor. So CSI checks that. Okay. Now remember that PSI is for the whole population. CSI is for just few columns. What is weight of evidence? WOE we call it. Weight of evidence measures the predictive power of your model. Just remember this. And there is a formula for weight of evidence. It's log of good divided by percentages of bad. What is logistic regression in credit risk? So basically, logistic regression is a statistical method. Obviously, all of you should know that. Then predict default probability between 0 to 1. That's how it functions. So if you draw the graph, if you Google it also, you will always see probability between 0 to 1. That's how logistic regression is very useful for this. Then model validation. What is model validation? So in model validation, you check a model which is developed by the model development team, and these are the metrics which you use. So these are metrics, okay? AUC, you should Google all of them, okay? But remember, when a question will come, how do you validate your model? So answer should be that we check the AUC, we check Gini, we check the calibration, stability, and backtesting. For stability, what do you do? PSI and CSI, okay, which we just spoke about. Then what is AUC and Gini? Area under curve and Gini coefficient. So basically it's simple, both are associated. AUC measures separation power, okay, the separation power, like the separation power of the model, good versus bad. How good is the model that it can separate good customer versus bad customer? That's what we check. Then Gini, there is a formula. So AUC multiplied by 2 minus 1. That's the formula here, if you see. Okay. Simply, that's how we calculate. Then what is vintage analysis? Very important. So we track the delinquency over time by the original month. Delinquency means I did not pay my EMI for 1 month. Now I am a delinquent customer. Okay. So after that, delinquency start. Like even if I flount only one EMI, I am a delinquent customer. Okay. Then what is the meaning of model drift? Sometime you hear in model validation that there is a drift in the model. Okay. So it occurs when model performance decline due to data or behavior changes. What do you mean by this? So let's say a bank who is operating in a market. Now they are planning to move into a bigger market. For example, a US bank is trying to move to Dubai. So now they acquire a small bank in Dubai. Now this data will be merged with the bank, right? So at that point of time, maybe the model may see a drift because the new data has been unloaded, like it has been loaded in the system. So there may be some changes. So now either we will rebuild the model or either we will calibrate the model. Okay, so that's what we do. Now let's talk about a bit aspect of SAS, SQL or tool based question. So SQL filter to default in 12 months. You can see select star all the columns from this column where flag default flag 1. That means the customer is already defaulting. And basically the thing you need to notice here, in the current date -12. So this is again something from the coding perspective, from SAS perspective. So that's why it's very generic. If you don't know SAS, you might not be able to understand it, but try to grasp this. Okay. Then inner join versus left join. So inner join returns the matching records only in both the column, while left join keep all the records from the left table and only the common from the right table. Monthly processes in SAS. So this is pretty much self-explanatory. Don't focus on this. ProSQL for roll rates. Okay. It use select and count star. Then what are the window function in SQL? To perform calculation across row. Like for example, there is one example, over is one of the window function. Then macro creation in SAS, there are various method. So the two most popular one, like you use %macro. This is the starting keyword and then you start the macro. Then you have ProSQL. Inside the ProSQL using amend, you do this. There are 2-3 more methods which are very popular, but these are the 2-1 which are like mostly people take the name of this. Then there is global and local macro, all those things you should read about it before going for your interview. But this session will actually give you that clarity that now you know all. At least you should be able to memorize using these one-liners. Then proc means summary frequency used for numeric stats and category summarization. Okay. Then how do you merge the bureau data with the bank data? Usually using a customer unique ID, which is primary key. Okay. Then detect data anomalies, like compare BAU versus bank variable, and then we will flag the mismatches. So that will give us the fair idea about the anomalies in the data. Then how do you optimize SQL? If somebody asks you in your interview that how do you optimize a SQL code, what should be your answer? So say we will not create table, we will try to create index because index take very less space. Then avoid using select because it select the whole data. Okay, try to only catch up only that much chunk of the data which is required, and then use explain. This will tell you about the whole table. So then you can take accordingly a decision wisely that whether I should use this or not. Okay. Then indexing is very popular, guys. You should definitely use this. Now let's move on to domain versus business question. So early warning indicators. What does that mean? So bank always set early warning indicator if the customer may be defaulting in the future. So that's called predictive modeling. Okay. So behavior and finance signs like payments, high utilization, all of those columns are very much popular. Okay. Then what is delinquency? As I said, failure to pay the dues, 30 plus DPD, 60, 90, after 90 days DPD, the customer is default. Okay. Roll rate versus migration analysis. So it tracks account movement between delinquency buckets like 60 to 90, 90 to 60. Some customer may come back from 60 to 30 again. Okay. And we will check that whole episode, and then that customer can become a normal customer also, because there can be some situation when customer could not pay EMI, he could not pay the EMI for let's say 2 months, but now he's able to pay. Okay. So charge off versus write off. Charge off means loan is uncollectible. Now we cannot collect the loan for so and so reason. Write off means accounting removal. In the books of the bank, you will show that the loan has been written off. It's a loss. Then collection strategies. What are the collection strategies which bank follow? So prioritize account based on the risk score and delinquency stages. That's why we track the delinquency. It's very important aspects. Then credit line management, like adjusting the credit limit based on the risk segmentation and the credit worthiness of the customer. Okay. What are the effects of rate changes? So higher the rate, higher the probability of default. Okay. The lower the rate, lower the probability of default. Revolver customer, pay minimum due and keep on revolving through that cycle, always paying the minimum balance and then paying some additional amount to the bank as a late fees and all that. So that's a revolving customer. Those are the most beneficial customer for the bank. What is microeconomic impact? Like higher the inflation, unemployment. So inflation, unemployment are the macroeconomic factor. The biggest example is Iran-US war at the moment. Okay. So that's increasing the probability of default in Iran region. Retail versus wholesale. Retail talks about an individual customer like you and me, who are taking car loan, home loan, or any kind of loan. Wholesale talks about the corporate, like Infosys, TCS, big companies and all that. Now let's move on to some regulatory questions directly. So somebody can ask you in your next interview, what is the difference between Basel II and 3? So you can say that framework define capital requirement for credit market operational risk. That is Basel III. In Basel II, we did not cover all those aspects, and the percentages of the capital which they should keep as a buffer was low in Basel II compared to Basel III. Now, what is IRB approaches when you are building the model? So when bank think like internal PDLGD EAD model for the capital computation, that is internal rating based approach, that's called IRB. Then there is some regulatory body, they tell no, you should apply one more layer. So those layers are known as AIRB, advanced internal rating based approach. Okay. Now let's move on to the next one, risk weighted assets. So assets are adjusted for risk. The higher the risk, higher the RWA. In bank, RWA calculation is a very big aspect. So if somebody can ask you what is RWA, you can say all those assets of the bank which are associated with the risk are known as risk weighted assets. What is stress testing? So basically it simulates adverse scenario to test portfolio resilience. What is portfolio? Portfolio means like home loan. Okay. Stress testing means like we will check against the various situations. For example, COVID. Okay. So we will check our portfolio in terms of like if again COVID comes in like 2027, how the portfolio will survive or bank will collapse. Bank should not collapse. So that's why we do the adverse scenario testing. That's called stress testing. Then IFRS 9 CCL, like it's the global accounting standard. IFRS 9 is a whole set of bunch of rules. IFRS 9 is a model. CCL is a test. CCL is a subset of IFRS 9. Just remember that. Don't ever say that IFRS 9 and CCL are the equal standards for modeling. It's not. Now, what are the ECL stages? There are 3 stages, expected credit loss stages. Stage 1, 12-month ECL, then lifetime, then default assets. That's what as per IFRS 9. I hope it wrote PD term structure. So PD projected over future period for lifetime ECL. Lifetime expected credit loss, that PD which is projected for that is known as PD term structure. Now 12-month versus lifetime ECL. So 1 year expected loss is 12-month and then full loan life expected loss. That is again a calculation bank do. I know it's very futuristic, but bank has to do that. Then IFRS 9 validation. So as I told you already, you remember AUC, Gini coefficient, all of that, those should be your core answer, that how do you validate IFRS 9 using those techniques. And then you can add that data quality check, then you do segmentation, then you check the performance monitoring of all these models. Okay, time to time. There are different teams. So if you are in modeling team, if you are in monitoring team, if you are in like validation team, depends on your role. Okay, but this model performance monitoring is a separate team, not the model developer usually. Then model governance. So control ensuring model quality. It's pretty much easy. Now let's talk about some scenario based question. So default rates. Somebody can ask you when the default rate increase. So you can say like investigate by product, vintage and macroeconomic factor of the economy. On the basis of that default rate increase, and how we solve that, we recalibrate the model, like we adjust the parameter described inside the model. Okay, then let's talk about credit risk dashboard design. So it includes so many KPI like delinquency, PD trend. It's very easy. Data mismatch resolution, reconcile by unique customer ID and verify, always verify the sources. If somebody asks you like how do you solve the data mismatches issue, this should be your answer. Okay, then automate monthly score monitoring. So we use either SAS or Python. You should know that. You should be expert in any of them. Model performance deteriorations. So again the same thing, it's talking about model performance monitoring or model validation technique, so you know about that. CSI for bureau accuracy, like we check the consistency of every column which we are getting from the bureau. So that's what CSI do, as I told you earlier. Portfolio quality report. How's the portfolio quality report? Depends on these aspects. Delinquency, default percentages, recovery, how many recoveries you have done, what are the risk segment, is there more people in the risky segment, least risky, all those things does matter, guys. Then identify high risk customer. So we use PD or decline score to flag proactively collection of those kind of customers which are highly risky. So bank can keep a proper eye on those customers. That's why we do it, like bucketing the customers. Test new credit policy. So we run A divided by B test. Like what does that mean? We basically compare default versus approval rates. So that is A is your default rate, B is your approval rate. Okay. Roll rate metrics. So it monitor transit of account across DPD buckets. So that's roll rate metrics. Like in 60, 90, 30, all these DPD bucket, how moments are happening. That is known as roll rate metrics. I hope this was a meaningful session for all of you, and I will put this particular file also in the GitHub, and you can find the link from the description box. It's very helpful, and I know it's not giving you so much theory, so many codes, but when you go for an interview, you need to remember the one-liner. You can build a story on top of that. So build a story, crack the interview and earn so much. Okay, so that's my goal to help all of you. I hope if you like this video, please make sure you subscribe to my YouTube channel, and please hit the like button, and please put your comments if you have any question. Make sure you download this file, okay, in the description box. Thank you so much.